Hey everyone, welcome to the show. Today's episode, Credit Union Secrets. How to get approved for high-limit credit cards even with imperfect credit. Discover the member-owned financial institutions that say yes when big banks say no, and unlock the credit limits that change your financial life. This one's made for anyone who has been denied credit by traditional banks, has limited credit history, is rebuilding after financial hardship, or wants higher credit limits without the gatekeeping of major financial institutions, and by the end you'll have real, practical skills you can use right away.
I'm really excited about this one. Here's what we're covering together today. Module 1, Understanding Credit Unions and Why They're Different. Module 2, Finding and Evaluating the Right Credit Unions for Your Situation. Module 3, Optimizing Your Application for Maximum Approval Odds and Credit Limits. Module 4, Growing Your Credit Limits and Leveraging Credit Union Membership Long-Term. Grab a coffee, get comfortable, and let's dive in.
Alright, let's get into it. That brings us to Module 1. Module 1, Understanding Credit Unions and Why They're Different. Explain clearly how credit unions operate differently from banks and why that difference gives everyday people a significant credit advantage.
In this part of the show, we'll talk through banks vs. credit unions, the fundamental difference that changes everything, how credit union underwriting works, the human factor in lending, the membership model, how open charters are your golden ticket.
Here's something most people never learn in school. Not all financial institutions play by the same rules. When you walk into a big bank and apply for a credit card, that bank is working for its shareholders, not for you. But a credit union? That's a whole different animal. Credit unions are member-owned, which means when you join, you're actually a part owner. That changes how they treat you. They're not trying to squeeze profit out of every decision. They're trying to serve their members. And that's exactly why people who get rejected by Chase or Bank of America often get approved at credit unions with surprisingly generous limits. Let me break that down a bit more. Credit unions are not-for-profit financial cooperatives owned by their members, meaning every person who joins becomes a part owner of the institution. Unlike commercial banks that answer to shareholders and prioritize profit, credit unions reinvest their earnings back into better rates, lower fees, and more flexible lending standards for their members. This structural difference means underwriters at credit unions are often empowered to look at your full financial picture rather than just a credit score. A person with a 620 credit score and a stable job may get approved at a credit union where a bank would have auto-denied that same application. Understanding this fundamental distinction is the foundation for using credit unions strategically to build and access credit.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this. Credit unions serve their members, not shareholders. That structural difference is exactly why they can approve people that banks reject. Okay, quick pop quiz for everyone listening. What is the primary structural difference between a credit union and a commercial bank? Your options are: credit unions are government-owned financial agencies. Credit unions are not-for-profit cooperatives owned by their members. Credit unions only serve people with excellent credit scores. Credit unions are subsidiaries of major national banks. Take a second and lock in your answer.
Alright, the correct answer is credit unions are not-for-profit cooperatives owned by their members. Credit unions are member-owned cooperatives that reinvest profits back into member benefits rather than paying shareholders, which is what allows them to offer more flexible lending terms. Picture two people applying for the same credit card, same income, same credit score. One applies at a big national bank, the other at a local credit union. The bank spits out an automatic denial in 30 seconds. The algorithm saw a late payment and that was it. But at the credit union, someone actually looks at the file. They see the late payment, sure, but they also see 2 years of perfect payment history since then. They see a stable job. They see that this person has been a member for 3 years. And they approve it. That's the human factor, and it's one of the most underrated advantages credit unions have to offer. Let me break that down a bit more. Traditional bank credit decisions are largely algorithmic. Your application feeds into an automated system that approves or denies based on rigid scoring thresholds. Credit unions often use manual underwriting or a hybrid model, where a real human loan officer reviews your file and can factor in context that an algorithm ignores. For example, a loan officer at a credit union may consider that you had a medical emergency 2 years ago that caused late payments, but your history has been spotless since then. They can weigh your employment stability, your tenure as a member, and your overall relationship with the institution. This human element is incredibly powerful for anyone who has a complicated financial story but a genuine ability to repay.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this. Credit unions often have humans reviewing applications. That human judgment is your opportunity to tell a fuller financial story than any algorithm would allow. Okay, quick pop quiz for everyone listening. What is a key advantage of credit union underwriting compared to large bank underwriting? Your options are: credit unions never check your credit score. Credit unions use human review that can consider context beyond just credit scores. Credit unions approve everyone regardless of financial history. Credit unions only approve applicants with perfect payment history. Take a second and lock in your answer.
All right, the correct answer is credit unions use human review that can consider context beyond just credit scores. Many credit unions use manual or hybrid underwriting where a loan officer can consider your full financial story, including circumstances behind negative marks, rather than relying solely on automated score cutoffs. One of the biggest myths about credit unions is that you can't join unless you work for a specific company or live in a tiny geographic area. That used to be mostly true, but the landscape has shifted dramatically. Today, there are credit unions with open charters that will accept pretty much anyone in the country. Sometimes all you have to do is make a small $5 or $10 donation to a partner charity and boom, you're eligible for membership. Once you're a member, you have full access to their products, including their credit cards, so the barrier to entry? Much lower than most people think. Let me break that down a bit more. Historically, you had to work for a specific employer or live in a specific region to join a credit union. These are called field of membership restrictions. However, many credit unions today operate under what's called an open charter, meaning virtually anyone in the country can join, often by making a small donation to a partner nonprofit organization or paying a nominal membership fee. Some credit unions have expanded their field of membership so broadly that they effectively serve anyone in the United States. Researching whether a credit union has an open charter or a community-based charter that covers your area is the first practical step to accessing their products. Websites like mycreditunion.gov and the NQA database can help you identify credit unions that serve your area or are open to the general public.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this. Open charter credit unions let nearly anyone join. A small donation to a partner nonprofit is often all it takes to unlock access. Okay, quick pop quiz for everyone listening. What does an open charter mean in the context of a credit union? Your options are: the credit union offers zero-interest products to all members. The credit union accepts members from virtually any background or location, often through a simple process. The credit union has no membership fees of any kind. The credit union is only open during extended business hours. Take a second and lock in your answer.
All right, the correct answer is the credit union accepts members from virtually any background or location, often through a simple process. An open charter allows a credit union to expand its field of membership broadly, often enabling anyone in the country to join through a simple eligibility pathway like donating to a partner nonprofit. Okay, moving right along. That brings us to Module 2. Module 2. Finding and evaluating the right credit unions for your situation. Identify, research, and evaluate specific credit unions based on approval flexibility, credit limit generosity, and membership accessibility.
In this part of the show, we'll talk through the 5 types of credit unions most likely to approve you, how to research a credit union before you apply, reading credit union card terms, what high limits and good cards actually look like.
Not all credit unions are equal when it comes to who they'll approve and at what limit. So rather than throwing applications at every credit union you can find, which just racks up hard inquiries, you want to be strategic. There are really 5 buckets worth focusing on. Credit unions built specifically for underserved communities, ones with wide open membership, ones that focus on member relationships, ones with secured cards that grow into real credit lines, and tech-forward credit unions using modern approval models. Figure out where you fall on the credit spectrum right now, and then you can match yourself to the right type. That targeting approach is what separates people who get approved from people who just collect rejection letters.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this. Match your credit profile to the right category of credit union. Strategic targeting beats random applying every time. Okay, quick pop quiz for everyone listening. Which type of credit union is specifically designed to serve underbanked or financially underserved populations? Your options are: investment credit unions, community development financial institutions (CDFIs), employer-sponsored pension unions, regional shareholder cooperatives. Take a second and lock in your answer.
All right, the correct answer is Community Development Financial Institutions (CDFIs). CDFI are specifically certified to serve underbanked and low-income communities, making them among the most flexible when it comes to approval criteria for people with imperfect or limited credit. Before you ever click submit on a credit union application, you want to know as much as possible about what to expect. And I don't just mean reading their website. Marketing copy is always rosy. What you really want is data from real people. Head over to Reddit, search for the credit union's name in the personal finance or credit card communities, and read what actual members say. Someone might have posted 6 months ago that they got approved with a 615 score and a $5,000 limit. That's gold. You also want to know if they offer pre-qualification with a soft pull, because that way you can check your odds without it affecting your credit score at all. Do your homework first. Apply second.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this: always check if a credit union offers soft pull pre-qualification. It lets you shop without the credit score cost. Okay, quick pop quiz for everyone listening. What is the advantage of a credit union offering a soft pull pre-qualification option? Your options are: it guarantees you will be approved for the card. It allows you to check approval odds without a hard inquiry affecting your credit score. It waives the annual fee for the first year. It automatically increases your credit limit after pre-qualification. Take a second and lock in your answer.
All right, the correct answer is: it allows you to check approval odds without a hard inquiry affecting your credit score. Soft pull pre-qualifications let you see whether you are likely to be approved before a formal application, protecting your credit score from unnecessary hard inquiries. Here's a trap a lot of people fall into. They get so excited about getting approved at a credit union that they don't actually look at the card terms, and then they end up with a card that has a $1,500 limit, a 24% interest rate, and no rewards. That's not a win. You want to know before you apply: what's the maximum limit they offer? Is there a clear process to request increases? Does the card report to all 3 bureaus? What's the APRA ceiling? A truly good credit union card should be competitive with what the big banks offer. The main difference is just that the credit union is more willing to give it to you. Set a standard for what you're looking for and don't settle below it.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this: a credit union card is only worth pursuing if its maximum limit and terms are genuinely competitive. Approval flexibility without good terms isn't a real win. Okay, quick pop quiz for everyone listening. When evaluating a credit union credit card, which factor most directly affects your ability to manage credit utilization effectively? Your options are: the color and design of the physical card, the credit union's number of branch locations, the maximum credit limit the card offers, whether the card has a chip or magnetic strip. Take a second and lock in your answer.
All right, the correct answer is the maximum credit limit the card offers. A higher credit limit gives you more room to keep your utilization ratio low, which is a major factor in credit scoring. Cards with very low caps limit your ability to manage this ratio effectively. Okay, moving right along. That brings us to Module 3. Module 3. Optimizing your application for maximum approval odds and credit limits. Prepare your financial profile, application strategy, and timing to maximize both approval probability and the starting credit limit offered.
In this part of the show, we'll talk through building your credit union relationship before you apply, preparing your credit profile for maximum impact, the application strategy, timing, positioning, and requesting the right limit.
This strategy is one that separates people who get mediocre results from people who get spectacular ones. Before you apply for a credit card at a credit union, become a real member first. Open a savings account, maybe a checking account. Set up even a small direct deposit. Use the account for a few months, because here's what happens behind the scenes. The underwriter or loan officer who reviews your credit card application can see your deposit history. They can see that you've been a reliable, active member. That internal relationship data works in your favor in ways that no external credit score improvement can replicate. Give it 3 to 6 months and then apply. Your odds and your limit will both be better.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this: open a savings or checking account first and bank with the credit union for 3 to 6 months before applying. That internal relationship is powerful underwriting evidence. Okay, quick pop quiz for everyone listening. Why does establishing a banking relationship with a credit union before applying for a credit card improve your approval odds? Your options are: it automatically waives all credit checks for existing members, it provides the credit union with internal behavioral data that demonstrates financial reliability, it qualifies you for a government-backed credit guarantee, it ensures the credit union reports your deposit history to all three bureaus. Take a second and lock in your answer.
All right, the correct answer is, it provides the credit union with internal behavioral data that demonstrates financial reliability. Credit unions can factor in your internal account history, deposits, balances, and usage patterns when making lending decisions, which supplements your external credit profile with real behavioral evidence. Even though credit unions are more forgiving, you still want to show up looking as strong as possible. Think of it like a job interview. You don't show up in yesterday's clothes just because you heard the interviewer is laid back. You still put your best foot forward. In the 2 to 3 months before you apply, knock your credit card balances down as much as you can. Check your credit reports for errors and dispute anything that shouldn't be there. Don't apply for anything else during that period. And pull together your income documentation because credit unions are much more likely than banks to actually ask for it. Show up prepared and you'll get a better offer. It's that simple.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this: in the 90 days before applying, reduce utilization to under 10%, dispute errors, avoid new inquiries, and gather income documentation. These 4 steps can significantly improve your outcome. Okay, quick pop quiz for everyone listening. What credit utilization percentage, ideally achieved before applying, is most beneficial for maximizing your credit profile? Your options are: below 75% on each individual card, below 10% overall across all credit cards, exactly 50% to show active card use, above 80% to demonstrate card dependency and need. Take a second and lock in your answer.
All right, the correct answer is below 10% overall across all credit cards. While below 30% is considered acceptable, keeping overall utilization below 10% typically produces the highest credit score impact and signals excellent credit management to lenders. Most people treat a credit application like a passive form. You just fill in the blanks and hope for the best. But there are real decisions you can make that shift the outcome. First, apply mid-month. It sounds small, but it matters. Second, when you report your income, include everything: side hustle income, freelance work, and if you're over 21, household income you have reasonable access to. The regulations actually allow this. Third, when they ask what limit you want, don't lowball yourself. If the card goes up to $15,000, ask for $12,000. You're not being greedy. You're anchoring the conversation. And if you get approved for less than you wanted, call and ask for a reconsideration right then. You have nothing to lose.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this: report all eligible income including household income, request an ambitious but realistic limit, and always ask for reconsideration if your first offer is lower than expected. Okay, quick pop quiz for everyone listening. Under Regulation Z, what type of income can applicants over age 21 include when reporting income on a credit application? Your options are: only their primary W-2 employment income, household income they have a reasonable expectation of access to, only income from government benefit programs, future projected earnings from planned investments. Take a second and lock in your answer.
All right, the correct answer is household income they have a reasonable expectation of access to. Regulation Z explicitly permits applicants aged 21 and older to include household income they have reasonable access to, such as a spouse's income, which can meaningfully increase the income figure used in underwriting. Okay, moving right along. That brings us to Module 4. Module 4. Growing your credit limits and leveraging credit union membership long-term. Develop a systematic strategy for increasing credit limits over time, building long-term credit union relationships, and using these accounts as a foundation for overall credit excellence.
In this part of the show, we'll talk through the credit limit increase playbook, from starter limit to maximum credit line, using multiple credit union cards to build a high-limit credit portfolio, maintaining excellent standing, and using credit union membership as a wealth-building tool.
Getting the card is step 1. But what you really want is to grow that limit over time, because a higher limit means lower utilization, which means a better credit score, which means even better opportunities down the road. Here's the playbook. After 6 to 12 months of on-time payments, call, don't click Call and ask for a credit limit increase. When you call, have your income information ready. Mention if you've gotten a raise or paid off other debt. Credit unions are remarkably open to these conversations. They're not trying to say no, they want to grow with you as a member. And even if they don't give you everything you ask for, they'll often meet you in the middle. That's still a win.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this. Call for credit limit increases. Don't click. A real conversation with a credit union rep is your opportunity to negotiate, not just request. Okay, quick pop quiz for everyone listening. Why is calling member services directly generally more effective than submitting an online credit limit increase request at a credit union? Your options are: phone requests are processed faster by federal regulation, credit unions lack online portals for limit increase requests, a phone conversation allows you to present context, negotiate, and build relationship in ways a form cannot. Online requests always trigger automatic hard inquiries while phone calls do not. Take a second and lock in your answer.
All right, the correct answer is: a phone conversation allows you to present context, negotiate, and build relationship in ways a form cannot. Credit unions emphasize member relationships and human judgment, so a direct phone conversation lets you make your case, explain your financial progress, and potentially negotiate a better outcome than a static online form allows. Once you've proven yourself at one credit union, you have the playbook, you know what works, and now you can replicate it. After 12 solid months with your first credit union card, start the process at a second credit union. Open the account, bank with them a few months, then apply. Space things out. Don't apply for 3 new cards in 3 months, because that's a red flag to anyone looking at your report. But over 2 or 3 years, you can build a portfolio of 2 or 3 high-limit credit union cards that together give you tens of thousands of dollars in available credit. At that point, your score reflects someone who is trusted by multiple institutions, and that opens doors to premium bank cards as well.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this. Build a credit union portfolio strategically over time. 1 card, prove yourself, then expand, spacing applications at least 6 months apart. Okay, quick pop quiz for everyone listening. How long should you generally wait between applying for credit union cards at different institutions to minimize negative scoring impact? Your options are: at least 6 months between applications, 1 week between each application, exactly 30 days to stay within the same scoring cycle, no waiting period is needed as long as you have good income. Take a second and lock in your answer.
All right, the correct answer is at least 6 months between applications. Spacing applications at least 6 months apart allows hard inquiries to age, gives your score time to recover, and demonstrates to lenders that you are not urgently seeking a large volume of new credit. Here's the bigger picture. A credit union isn't just a place to get a credit card. It's a financial institution that can serve you for decades. The people who get the most out of credit union membership are the ones who treat it like a relationship, not a transaction. Pay on time, keep your accounts healthy. Use their other products when it makes sense. Their auto loan rates are often fantastic, and their mortgages can beat what you'd find at a bank. Some credit unions even offer free financial counseling to members. And over time, when they see that you're a dedicated, responsible member, they come to you with opportunities. That is the real long game, turning a credit card approval into a lifelong financial partnership.
You know what really stood out to me there? If our listeners remember just one thing from this lesson, make it this. Think of your credit union membership as a long-term financial relationship. Consistent good behavior unlocks increasingly better products, rates, and opportunities over time. Okay, quick pop quiz for everyone listening. Beyond credit cards, which of the following is a common financial advantage that strong credit union members often access at better rates than traditional banks? Your options are: stock brokerage accounts with no trading fees, auto loans and mortgage products with lower interest rates, unlimited free international wire transfers, zero deductible insurance products. Take a second and lock in your answer.
All right, the correct answer is auto loans and mortgage products with lower interest rates. Because credit unions are not for profit and pass savings to members, they frequently offer auto loans and mortgages at lower APR than commercial banks, making them valuable partners for major life purchases beyond credit cards. And that's a wrap on credit union secrets. How to get approved for high-limit credit cards even with imperfect credit. You now have everything you need to put this into practice.
Thanks for hanging out with us today. Take what you learned, start applying it right away, and keep going. We'll see you in the next episode. Good luck out there.